The money measurement concept in financial accounting. The field of financial accounting is a realm where precision and objectivity are fundamental. At the core of this discipline lies the money measurement concept, which dictates that accountants should record items in financial statements only if they can be measured in monetary terms and with sufficient reliability. In this session, we will explore the implications of the money measurement concept, the limitations it imposes, and why certain valuable resources remain off the balance sheet. Introduction to the money measurement concept. The money measurement concept, a cornerstone of financial accounting, sets stringent criteria for what can be included in a business's financial statements. It demands that items must meet two fundamental conditions to be considered for recording. The first condition being they must be quantifiable in monetary terms, and the second condition is that the measurement must possess sufficient reliability. Under this concept, financial transactions and items that cannot satisfy both criteria are excluded from the financial statements. This seemingly rigid principle is rooted in the pursuit of clarity, accuracy, and comparability in financial reporting. The boundaries of tangibility. While the money measurement concept serves as a study framework for financial accounting, it establishes boundaries beyond which some crucial resources remain unaccounted for. Numerous valuable assets within a business do not align with these criteria, and these assets fall under the category of intangible resources. Consider the following examples. The quality of the ideas, energy, and attitude of business staff. A motivated and creative workforce is an invaluable asset for any company, contributing to innovation and success. However, measuring these attributes in monetary terms is a formidable challenge, as there is no universally accepted method for translating human capital into a financial figure. The reputation of a business's products amongst the public. A positive brand reputation can significantly impact a company's sales and profitability. Nonetheless, placing a precise monetary value on reputation is complex and often subjective, as it depends on various intangible factors such as public perception. The quality of the relationship between the business and its customers. Strong customer relationships can lead to long-term loyalty and repeat business. Yet these relationships are deeply nuanced and may defy precise monetary measurement. The unaccounted intangibles. These intangible resources undoubtedly hold substantial value for businesses, potentially bringing future benefits. However, as per the money measurement concept, they do not meet the stringent criteria of being measurable in monetary terms with sufficient reliability. Any attempt to attach a monetary value to these characteristics would involve a significant degree of subjectivity and guesswork. In essence, two independent opinions could produce widely different valuations for the same intangible asset. Therefore, these intangible resources are not included in the balance sheet, underscoring the rigor of the money measurement concept. This concept forms the basis for financial reporting, ensuring that financial statements remain grounded in verifiable objective data. In conclusion, the money measurement concept in financial accounting establishes the boundaries of what can be quantified and included in financial statements. It is the principle that items should only be recorded if they can be measured in monetary terms and with sufficient reliability. Valuable yet intangible resources such as human capital, reputation, and relationships fall outside this boundary due to the inherent difficulties in precisely measuring them in monetary terms. The money measurement concept reinforces the commitment of financial accounting to objectivity and precision in financial reporting, ensuring that data provided remains clear, accurate, and comparable. My name is Arnold Kisembo Ranga Kuramya. Thanks for watching.